Good morning, it's Jeffrey Cohen and a cork hat from Australia. In honor of all those down under that are dealing with a lot of market kind of flies. And so hopefully you could take the distraction. I know I can. So coming to you this morning at 6:30 Chicago time, Friday, April 8th. It's going to be a very exciting day in the markets today. I have a feeling this is where fortunes and memories get made. So we're going to talk about the top stocks. So how do I know what a top dividend stock is? Number one, it's listed in the United States. NASDAQ, New York Stock Exchange, NYSE American, and BATS and the other guys. It's traded every day. It passes our data validation, which is pretty extensive. It's profitable. And this is a major dividing line between stocks. We pick stocks with positive net income. It's efficient. So it has a risk versus return trade-off that's more attractive than the S&P 500. Now, what's funny is the S&P 500 is looking a heck of a lot better in all this market turmoil. And so there's one fewer stocks today. And then finally, dividends paid were greater than the yield on the dividends paid by the S&P 500 ETF. So really what I'm saying is these are the best dividend stocks to buy today if you had a little extra money versus putting the money in the S&P 500, which is where honestly more than half of our real savings is right now. So, but not our fun money when we try to make profit. So, number one, Blackstone. And I'm showing you a lot of stuff here, so hopefully you appreciate it and you enjoy it. I'm going to make it a little bigger for you. So Blackstone, it's so interesting. Blackstone and the Carlyle Group. I mean, you guys know these are money managers, right? These are deal guys. And so when Blackstone has a 12% return and it's a dividend yield of 3.6% and it's trading at about where it was last year, this is the average price, today's close versus the average price last year. This is pretty good. This is attractive. This is not a bad situation. And so I'm going to fix this for you. So funny. I'm so tired. Our data provider was a little slow last night. In fact, they only gave us the data this morning, so kind of hurt a little bit. Not that I was up all night, but freeze the column so you see the name of the stock. So, and I'm sorry, I keep trying to make this bigger for you. We'll figure this out. So, number two is APAM, Artisan Partners Asset Management, 11% expected return. Now, these expected returns are inclusive of the dividend yield. Dividend yield is 8.2%. So, now this stock is down 15%. I want you to think about it for a minute. This reminds me of Verizon Wireless, Verizon Communications. So APAM is expected next year to deliver 11%. They got an 8.2% average dividend yield from last year. You lost 15%, you made 8%. Were you happy? Carlyle Group, number 3, CG. Expected returns 11%. It's a 2.1% dividend paid last year. It's trading at an 8% discount over last year. It's down 8% versus last year. Qualcomm. We've been following. Qualcomm has broken a lot of hearts lately. But still, good expected return of 12%. Volume is up slightly at 7% up. It's down 7% over last year. And it delivered a respectable 1.8% dividend. Virtus Investment Partners, 11%. It's 1.7% dividend. It's down 22% over last year. It's one of the higher variances in this little list, tiny shrinking list of dividend stocks. Guess, the jeans, the clothing maker. Surprisingly, these guys are here, and so something's up with this stock. Expected returns 14%. It's the highest of the group. Paid 3.4% dividend last year. It's down only 4%, and the volume's up. Broadcom, AVGO. It's the last dividend stock. Expected returns 10%. 3%, actually 2.96% dividend paid last year. It's up 16%. So a lot of these tech stocks are down, but Broadcom seems to have held on to some of its gains. But volume is down, so I'm never quite sure. And the ones below fell fell below. Now this is important. These are the numbers. So number 34 and number 47 and number 58. So QQQ is the NASDAQ Composite ETF. Expected return 9%. Volume is up 21% over last year. Price is down 2% over last year. So if you were an investor in QQQ, you earned a whopping 0.5% dividend. You lost 2% of your money last year. If you bought it, equally every day over last year versus now. It's just so interesting. And you see the variance is it's kind of middle of the pack, which makes sense because it's an ETF. It's broadly diversified. But what's interesting is QQQ is scoring more efficient than the Spider. And I think that's just because it's lower. It's probably exhausted after all the losses it took. The S&P 500 ETF is up 2% versus last year. Again, the average every day. 1.32% dividend, and interestingly enough, the volume is falling. So less S&P 500 is traded. If we come down to the Russell 2000 ETF, IWM, normally this is where we play with our fund money, where we try to make a lot of profit in the market. Expected returns 8%. The volume is down, it's 93% of last year. The price is down 8% versus last year. And dividend yield is 1.0. What's interesting about that, it's 0.96. Higher dividend yield than QQQ. This is Main Street, right? And so just gave you a few stocks. Again, do your due diligence. Be careful. We publish these on our website. Blackstone, Artisan Partners, Carlyle Group, Qualcomm, Virtus, Guess, and Broadcom. So I did a little experiment. And I took a look at the down run, and I said, maybe there's a down stock. Maybe there's a dog money-losing stock that has a dividend better than the S&P 500, and there's none. Okay, so the truth is, the money-losing stocks on average aren't paying you the dividends you need. And just thought I'd check this time. All right, I want to thank you very much for listening. Peace out. Here's to the folks down under. And one last thing I'm going to do, just thought it was curious, is let's take a look at our up stock run. See if I can give you one or two insights today that maybe you didn't have. Now, normally I would never show this to anyone unless you were not just a paying customer, but a special paying customer. Let's see what I can show you here. Make this all bigger. Here's we're going behind the curtains now. This is a printout that I get on my hard drive when I run my model. The first thing is that the variance of the S&P 500 is higher than I'm used to seeing it. Not a ton, but it's up there. Market returns are just garbage, 5.9%. Who invests in the stock market to make 5.9%? And this is still with a risk-free rate of return of 1. Do you know the S&P 500 has delivered 10.15% over the past year? But you saw that it's only up 2% over last year. So Jeffrey, what does that mean? That's not consistent. Well, in fact, it is consistent. It means that the S&P 500 climbed early last year, fell into the end of the year, and is falling now. So 10.5% return, most of that was earned close to a year ago. The IWM return, the Russell is down almost 10%. It's awful if you bought it last year and you're holding on. We are bag holders. And the QQQ is up 5.54%. So just want you to think about that. These indices are all, think of it this way. It's like they've climbed onto a pedestal. They're up, they're high, and now they're coming down the other side of the trapezoid. The trapezoid effect is affecting our stock market. Okay. All right, so just so you know, the U.S. comp, by the way, I want to thank Intrinio. Intrinio, I know the guys were out working late last night. I want to thank you for being out there. I'm going to give them a little publicity right now. So Intrinio. Real-time data API, mission-critical systems, mission-critical data. The truth is, they give us the stocks that we need. They give us the data every night. And last night around 6:30, I know the guys were working hard because they were sending out trouble ticket updates. And so they fixed it overnight. Again, thanks to Intrinio for that. What else is interesting about the market? This is always something. Again, behind the curtains. The variance of all the stocks, money-making stocks, is 0.0012, or 1.2 times 10 to the negative 4. And so, if you bought all the profitable stocks, 1.2 times 10 to the negative 4, but if you just bought the S&P 500, 8.9 times 10 to the negative 5. So you're still a better risk profile buying the S&P 500 over. This is too much secret sauce. That's good enough. All right. Thanks for listening. You take care now. Bye-bye.